Fantastic, lovely. Thank you, the organizer, for having me here. I'm very, very happy. And I'm really very proud to have been asked to moderate such a prestigious panel. I would like to call here Giulio Faura, Chairman Enterprise Ethereum Alliance. Thank you for being here. I would like to call here Yasmin Al-Sharaf, Superintendent FinTech Innovation Unit, Central Bank of Bahrain. I hope she's around, or she will come soon. The next panelist is Sam Chadwick. Thank you, Director of Strategy, Innovation and Blockchain, Financial Risk, Thomson Reuters. Thank you to be here. Morning. Then we have Mohammed Al-Shali, I hope I pronounced correctly, founder of Arabian Chain. Thank you to be here. And then I'm proud to have here Veronica Lang, Global Head of Innovation, Chief Technology Officer of UBS. Thank you, Veronica. And let me call once again Yasmin, if she's here. I'm pretty sure that she's around. She's here? Okay. Welcome. Thank you to be here. Superintendent, FinTech and Innovation Unit, Central Bank of Bahrain. Thank you. So I'm very happy, and the panel the title is very exciting because blockchain, seen in the aftermath of blockchain tsunami, is a combination also of. The title is a little bit short. I would add also in the aftermath of the financial crisis, and the two things together are creating some interesting effects. So I was a central banker a few years ago. I did work for 2.5 years at the Deutsche Bundesbank, the Central Bank of Germany, on blockchain. I did open the research unit on blockchain there before leaving the central bank to found and run the currently University College London Center for Blockchain Technologies. My experience at the central bank was very, very nice and very, very instructive for me. And therefore, I would like to start with the first question for Yasmin. And the first question is basically about the Central Bank of Bahrain view about blockchain and cryptocurrencies. I remember my period at the central bank. We had a big bank, central bank with different heads, with different positions. At that early time, it was around 2013, 2014. We didn't have a clear public positions at that time, and it's interesting for us to know what the Central Bank of Bahrain think about blockchain and cryptocurrencies given its particular position in this global geographic area. Thank you.
Thank you very much, Paolo. Good morning, everyone. My name is Yasmin Al-Sharaf. I'm a superintendent at the FinTech and Innovation Unit at the Central Bank of Bahrain. Previous to that, I held the post of a superintendent at the Licensing and Policy Department for the past 12 years. I've been engaged in several of FinTech initiatives at the central bank, including working on regulations for crowdfunding and the regulatory sandbox as well. To answer your question, Paolo, we're talking about two very different things here. When it comes to blockchain technology or distributed ledger technology, I personally believe it is a game changer. It is an enabling technology. It will eliminate the need to have a financial intermediary, making financial transactions more efficient, less costly, faster. In general, the Central Bank of Bahrain has a very positive view towards blockchain technology. In addition to that, if the blockchain, as it claims, adds an additional layer of security because of the highly sophisticated encryption, then that is music to our ears as a regulator. Therefore, I believe that blockchain technology will be a fundamental technology in the financial and banking industry and in the medium term. When it comes to cryptocurrencies, on the other hand, that's a different story. The Central Bank of Bahrain does not recognize cryptocurrencies as official currencies. First of all, cryptocurrencies do not meet the definition of a currency as per our local laws, nor do they meet the characteristics or uses of a currency. Based on that, trading in cryptocurrencies is a violation to our local laws, despite the fact that a lot of nationals have started engaging in trading in cryptocurrencies using international exchanges, which is something beyond the central bank's direct control. We view cryptocurrencies more as highly risky commodities rather than a currency. We do not encourage the use of cryptocurrencies. They are not regulated. They are not backed by any government authority. Therefore, anyone wishing to trade in cryptocurrencies will do that at their own risks. Having said that, however, we at the Central Bank of Bahrain have been receiving a number of applications from fintech startups, from existing licensees, existing companies, intending to test out their business models which revolve around the use of cryptocurrencies. We have approved these companies to test out their ideas in our regulatory sandbox because we believe this will provide also us as a regulator with more, we'll learn more about how these cryptocurrencies work, how they may impact the financial industry, etc.
Thank you very much. Yasmin, it's very interesting, and I would like to take from this, and the interesting that position is that the cryptocurrencies, according to the central bank, is a commodity, is not a currency. I know that other jurisdictions, other financial market authorities think that cryptocurrency should be treated like any other foreign currencies. But I would like to do a step backward and to enlarge the topic of discussions and to see what also the industry think about blockchain and cryptocurrencies. And you know, during the last year, 80% of big banks started some pilot projects more or less at advanced stage in the blockchain space. 90+ central banks are indeed working on blockchain projects at the research or implementation levels. We have venture capital funds that invested $2 billion during the last years, $4 billion in ICO. The governments, 25+ governments, are indeed committed to invest in these projects. The European Commission just released some program for the Horizon 2020 research project, committing to invest 5 million euro. But this is all related not only to blockchain, this is also related to the new other technologies like artificial intelligence, machine learning, and all these type of new tools that you know, blockchain take part of as a toolbox. You know, as entrepreneurs, in the practitioner field, we need to think what are the tools available. And these tools allow, of course, for new digital currencies, but allow also for robo-advisor, allow for peer-to-peer lending, crowdfunding, all these new form of banking and finance. So I would like to ask my esteemed panelists here to share their opinion about blockchain and the fintech and how basically the banks embrace these new technologies and according to their experience, what are the major 3 impediments and challenges that they have seen?
Okay, thank you, Paolo. I think it's about 3 years ago that as part of building up our innovation portfolio at UBS, we initiated what we called the Crypto 2.0 Pathfinder program. And we were very clear at the time that it would be a journey and that we wouldn't have in 2016 production running blockchain applications. And I think that vision held true. So over the last 3 years, we've looked and incubated dozens of use cases with various partners. We've joined a number of the consortia that exist by now in the financial industry on blockchain, and have built up a good portfolio with, I think, about 6 cases that are ready to go into production in the coming 12 months or so. And what we've learned over the course of those projects, and even with the first proof of concepts that we did, like on smart bonds or on loyalty points on blockchain, was a recurring challenge, and that was always, unless we have digital identities in place, unless we have a form of digital cash for those distributed ledgers, it is very hard to really go into production. And on top of that, of course, we've also seen the gaps, and we've seen that we are making good progress on that in terms of legal framework and regulatory assessments of such solutions. So I think we've seen, not just at UBS, but also with our other partners and what we observed, some good progress towards production, and the use cases that we have in our portfolio are the ones that have also been mentioned yesterday. So we're talking about cross-border payments, we are looking into trade finance, into data reconciliation, and also one of our leading projects, which is the utility settlement coin, which is our approach, together with a consortium now of 12 banks, to initiate a form of digital cash that can be used to really have instant settlement in a regulated way.
Thank you, Veronica. I would like to know what the other thinks about these questions and what their experience about that.
Hello, everyone. So first of all, before I go into that, now the concept of distinction, basically, between blockchain and cryptocurrencies are not quite right, in my opinion. Because if you're talking about public and decentralized systems, for example, it would not work unless there is the incentive of cryptocurrencies that keeps these systems kind of running as economies in general. Saying that, basically, I understand basically the concern of central banks usually, when it comes to creating currency. So when you're talking about the decentralization or taking down the control basically over economy in a way. But we need also to understand that this is the way to enable, this is the way to empower, these kind of, applications and startups to be global. Because if we have the islands of blockchains that, everyone is building their own private chain in a way, then it's just, a distributed database that is sitting there, and we are not really achieving the potential of this thing. Why am I saying that? Because I come actually from banking background. I spoke with a central bank in 2011 about Bitcoin at that time. And I was asking them what do they have in mind? Like, how are you going to deal with this thing? Are you going to allow it, or are you going to reject it? And even if you want to, just put some regulations in there. This is in 2011 here in the region. And of course, I got the most interesting answer, which is no answer at all from that time. But the thing is, now they're coming to realize that there is a need, and this blockchain thing is not going away soon. So you need to deal with it in a way. And I see that even in Saudi Arabia, for example, the SAMA, or Central Bank of Saudi Arabia, was, kind of putting warnings against, dealing with cryptocurrencies, and they were saying, okay, blockchain is fine, cryptocurrencies are not. But recently, actually, they changed that statement into, if you're investing in cryptocurrencies outside of the country, then that's fine, as long as you're providing, a proof of fund. And what I'm saying is, why don't you actually allow the trading to be happening within your country, so you have more control into who's getting into this ecosystem? That's kind of, bring the transparency of the users of these kind of technology, or the user of these kind of tokens, more into the open. If you don't allow them, if you don't enable them, it will just go in the dark market, and this is what you don't want to do. Just a simple thing, the other day I posted, a small poll about what will happen if all 195 countries decided to outlaw Bitcoin, for example, or all cryptocurrencies together. And the answers, people participate, about 1,100 people participate into that. And it says basically nothing will happen. The cryptocurrencies will just go a little bit down and then they will come up again because it's a decentralized system and nobody can influence that like on the major scale. So you can impact it on a short term, but on the future, like on a longer run, it's just gonna be there. So we have to understand how to integrate with it rather than fight it.
Sam, what is your opinion about this?
So good morning, everyone. Yeah, Sam Chadwick from Thomson Reuters. So as you probably know, we're not a bank, but our customers all are. So our strategy has been to try to enable innovation to take place at our customers by providing tools and capabilities for use in the blockchain space. What we've seen, first of all, is that among our customer base, they fall into three groups. We have the leaders, two of which are actually here today, so UBS and Santander, and several other banks who fall into that category. Then we have the followers, which are typically the custodian banks. They know that this thing is going to impact them. They don't really want it to happen, but they're following on in ensuring that they understand the technology and reacting to it. And then the last group are all the observers, which I think falls pretty close to what was presented earlier for the 80% that the Microsoft gentleman mentioned. There are a lot of people watching, don't really know how to start, and I spend a lot of time talking and educating them on what their peers are doing, for example, and what the other successful projects and not unsuccessful projects are. So to answer your question directly, I made a list of, I guess, the biggest obstacles that face the customers that we've been speaking to. And they fall into two categories. Category one are technology issues, and category two are the business issues. And around the technology side, I think you'll probably hear from the other panelists on this more, but interoperability comes up as a big topic, scalability and just the volume of transactions that can be processed, security and encryption, yes, it's seen as a benefit. When I was speaking with the Central Bank of Russia, they said there is absolutely no damn way we are trusting anybody's encryption apart from our own. So they have forked technology and used their own encryption layer because they're not going to trust anybody else's. Private key management is an issue. Falcon Private Bank issued and now takes or enables its investors to invest in Bitcoin, but they won't manage the private keys. They've outsourced all of that. There aren't many banks that I speak to who are happy with their own security to an extent that they're willing to manage other people's private keys. And then lastly is integration with off-chain data. And we've built a capability called Block 1 IQ. It enables Corda and Ethereum blockchains to interface with our data, our market data, for use in smart contracts. So our customers are typically creating things like interest rate swaps and taking the LIBOR value that's needed for that computation from us as a trusted independent third party via our Block 1 IQ adapter into something like Ethereum. So those are the tech few, and if I could just mention a couple of the business ones. Again, I think the gentleman from Microsoft covered a couple of these, but governance is a huge problem. Right? Actually, when we start setting up the projects, the biggest obstacle is not necessarily the tech. We can get that working quite quickly. It's actually getting groups of banks to be friendly and work with one another. That's really hard. Most of them are very used to controlling things and doing things their way. And so when you get a couple of them at the table, it becomes hard, especially when the compliance officers come in and get involved. Because they say, what, our data is leaving the walls of our bank? Are you kidding me? We don't want that. Our data stays inside the walls of our bank. So lots of discussions around that happen. There's a typical resistance to change. I think that's common inside most organizations. There's a migration risk. Again, that's pretty common with any technical kind of evolution. And then just to echo Veronica's point earlier around identification, I believe that is probably the last one. Off-chain identifiers is actually really hard to deal with, to ensure that somebody who's participating on a blockchain is actually has an identity that is represented off-chain. So let me give you an example for what we did with our data feed. If you were to write a smart contract which called out using the ticker C to get your market data from NASDAQ, or NYSE, let's say, and you were doing that back in time, 1997, you've written this wonderful smart contract, C.N suddenly changed hands. It stopped being Chrysler and started being Citibank. Now that's a problem for your smart contract because you can't go and change smart contracts. Right? Once they're written and published, that's it. So your identifier needs to be consistent. And what we've done is create something called PermID, Permanent Identifier, and it's an open creative, under the Creative Commons license at permid.org, and it enables you to write smart contracts which leverage off-chain identifiers, and you know that they're going to stay permanent. So those are sort of the key obstacles that we've seen so far.
Fantastic, lovely. Thank you very much. I think it's a huge list, and there is a long journey to address all of them. And the fact that you mentioned these two groups is also indicative that we may need a complex approach to this complex problem. So we need to put together a different type of expertise from inside the company. So what is, Giulio, your opinion about that?
Yeah, so I think when we started looking at this, I think it was 2014, the world was about Bitcoin, was not about blockchain, right? And probably in the fall of that year, we started to talk about blockchain and we started to be seduced by the underlying technology, not so much about the cryptocurrency. I think we ignored the cryptocurrency for some time until probably this past year, when it's kind of difficult to ignore, right? And I think it's I think it's quite important to distinguish both things. So one thing is decentralization, right? And decentralization is something that can be useful because it can make things more efficient and it can make things more interactive, right? In general, bank systems have not been, well, enterprise systems in general are not designed to be interoperable, right? They are designed to be autistic as much as possible because we want to make them really safe, really secure, right? And therefore, whenever you try to make connectivity, right, between systems, it's always difficult. It's always difficult because these things are really designed to be secure. So I think in the past years we've been working to try to interconnect better these things using blockchain's protocol, and that I think is very valuable. So we mostly do these things through what we call tokenization. Tokenization means to represent digitally the assets we have in our balance sheets, for example, or any other enterprise systems if we're not a bank, right? And once we create these digital representations of assets on smart contracts, for example, that live on a shared ledger, then we can build new natively digital applications on top of that on those smart contracts in the ledger. I think that is a fascinating idea that can lead to a lot of benefits in terms of more interactivity, more real-time things. I mean, real-time service, better service, more efficiency, and so on. Now, this is what we've been focused on solving for the past 2 or 3 years. We're still not there, as you were saying, but there's a lot of advancements. So now we start to have governance mechanisms to do it. We're still experimenting with them, and not just in the financial industry. It is difficult to get banks to work together, it is true, but when you try to get banks with non-banks to work together, it's even more difficult, right? I can speak on behalf of Alastria, which is the multi-sectorial blockchain network we launched in Spain. It's 160 members. You have utilities there. You have telco companies. You have oil companies. You have banks, of course. And it is difficult, but you can make it. You can make it work. And the technology is starting to get ready by the minute. Now, beyond interconnectivity and communication, now what we are now going back to the reflection of this idea of decentralization to store value. So the decentralization of the store of value, that is, that's a completely new paradigm, and that's where cryptocurrencies come in play. I think as a first place, the first thing what we are trying to do is explore the ideas of have stores, decentralized stores of value that are not cryptocurrencies, for example, this utility settlement coin project that we launched actually together with UBS and others, which is this idea of creating digital representations of fiat money backed by central banks. That's a lot like a cryptocurrency, except that it is backed by central bank money in this case. So it provides you a store of value, but it does not have the problems of cryptocurrencies. And the main problem of cryptocurrency is anonymity, right? It's difficult to, it's impossible to identify who is behind them, and therefore they are able to be used for money laundering. And this is something that in the industry, in the banking industry at least, we cannot afford to really work with things that can enable money laundering. I mean, the whole industry has spent a lot of time and a lot of effort to try to stop these things, and it is not something we can afford to do.
Thank you, Giulio. Okay, fantastic. So I would like to move now to to the positive side. So we have seen some challenges. Our panelists also mentioned some key drivers of the blockchains, decentralizations, new technology to store value. I would like to go back again to Jasmine and to ask her what is her opinion about the future of this blockchain environment according to the blockchain of Bahrain, what they envision in the future, the development of this technology.
Sure. I believe that we're still in very early days. Blockchain technology is still evolving, especially in this region. When it comes to application, our financial and banking industry, they're still in the infancy stage. It still hasn't matured. However, at the rate that blockchain is evolving, I believe that very soon in the medium term, let's say, it will be a fundamental technology and it will change the way that traditional banking has been operating. It will take some time for banks to move towards technology, to depend less on the financial, on the human factor, and to move away from traditional banking. But it will happen very soon in the medium term. We at the Central Bank of Bahrain encourage innovation. We encourage our banks to invest in technology. We believe that blockchain will open a means of easing financial transactions in a number of ways. Some of the use cases of blockchain that I can think of, the best use cases will be especially beneficiary when it comes to remittances, when it comes to payments, financial trade, even the digital storage of information. So to answer your question, yes, in the medium term, I believe blockchain will be a fundamental technology in the banking industry.
Do you have in mind any specific, working applications? I think this is too early, but maybe at least at the early stage, if you have in mind something specific, if you can mention some examples for us, would be very, very, very appreciated. And we know that, as Jasmine said, remittance payments, cross-border payments, transactional banking, and so on. But do you have something in mind specifically for us? Veronica?
Maybe I can mention two different projects that we're working on, and just to illustrate, I think, the approach for that. I think Jasmine already mentioned payments and post-trade, and those are definitely very interesting use cases. But what is really important is to look at what is the business model and how will the value chain change with blockchain in the industry. So it's not just about taking a new technology which uses distributed databases and decentralized networks to do the same as before. So when we look at our trade finance project, we particularly looked at what can we do with blockchain that we couldn't do until today in the space of trade finance. And let's face it, if you have large companies trading with each other and you have a functioning distributed ledger underneath and cryptocurrencies or some digital cash, they could effectively create the trust between each other, and there would be the big questions, does it actually need a bank in between to do the payments? So that is a very aggressive scenario, but we wanted to understand just beyond digitizing an existing trade finance process, where you have today the letter of credit generation, which involves a huge amount of paperwork and many steps and many involved parties, and it typically takes up to 7 days until you have all the documentation ready for a letter of credit that goes with a specific shipment. So we looked at how can we digitize that, but also take the benefits of blockchain to add more value to it. And that resulted in our project Batavia, which we are running with some other banking partners and IBM, and on the Hyperledger platform. And it really combines a new tool where you have not only the shipment information, you have logistics information, you have the financing, the FX possibilities to back up that trade. So you have one system that brings things together, and the feedback from the clients that we're working with in the concept design phase, but also now towards piloting, has been very positive, because it creates an additional value, because we have basically taken the good things of bringing different parties together and adding information to it. And that will expand further with IoT information, connected devices that you can bring on that as well, that you can track the shipments as they go from one port to another, and automating it end to end. And that creates new business models and is very valuable. So I think that's the one example. The other example is that we are doing with, and I think Sam mentioned it before, and the MADREC project, that, as it's called, it's a short term for massive anonymous data reconciliation. And what it is it's a project in the efficiency play, really. It's about aligning all of that data, all the legal identifiers that we need to comply with MiFID II. And instead of each bank sort of trying to clean up their data by itself, it's creating almost like a utility for the industry, where everybody can check against the other partners about whether the legal identifier information that they have, and that contains things like an address of an entity, or when it was created, when it will expire. All of that information needs to be always accurate and up to date. But it helps you to just understand whether you've got any anomalies, and it increases the value and the quality of your data. So that's not visible really to the client, but it creates better services for us as a whole.
Fantastic. Very exciting. Thank you very much. Mohammed, do you want to list some?
Sure. So actually, we as Arabian Chain, one of the things that we are focusing on. So besides just creating, the first public and decentralized blockchain in Middle East and North Africa, I mean, we went in to help people to realize some of the use cases in this, and we started with the financial sector, for example. And we and our partners, the Gibran Network, so they have something called the Gibran Network, and the Gibran Network's aiming to tokenizing assets at the beginning, and then going into moving the whole consumer banking into the chain. So they're starting with the tokenization of treasury bills, debt instruments, and some other assets. Cash, for example, so they have something called the J-Cash, and that is basically by pegging, digital tokens into existing, fiat currencies or reserves in general. So these kind of tools or instruments that you allow, banks actually to adopt blockchain without having to deal with all the infrastructure part themselves. So, since it is a public and a decentralized system, and it is truly decentralized in a way that you can just, link all your assets and just present them as a token on the chain. And it's kind of opened a whole new market for the bank today. So banks today, they have their assets, And if you are able to tokenize that and open up to this new market, which is valued over like 600 to 700 billion dollars today, and it might go, somewhere else like by the end of year, the whole growth of that market, the banking industry today that don't have that direct access to that market. So by the tokenization of these assets, allowing them to sell it actually on, or to present it to this new market. And there is the whole benefit of the arbitrage that goes, between the off-chain and on-chain kind of, difference in value that happens. So it's kind of, a new opportunity for these banks to benefit from. And the other part is actually we're also focusing on building Islamic banking products. As it's an industry that is valued at $1 trillion of value when it comes to asset size. And since nobody is like paying too much attention into that, so we figured out that somebody should be doing something. And one of those things that we started with creating the whole loan process on the chain. So as the Islamic banking is actually a commodity-based banking, they need to have a commodity in the middle to do lending. So that means that there are multiple parties involved. They need to trust each other. There is a whole interaction that is happening. So putting it on blockchain, it's actually removes the friction and makes the process easier, faster, allowing the banks to generating actually more income from that. So this is one of the things that we do.
Thank you very much. Also this project is very, very exciting. Sam, what do you think? You want to add something?
Sure, yeah, absolutely. Maybe I'll be a bit controversial here, let's see. So I think when we started our strategy 2 years ago, looking at this space, the tokenization piece was almost a no-brainer. Right? People were doing colored coins at the time, effectively making tokens represent other things. And banks had a digitization strategy even at that point in time. And then, this is a pretty obvious use case for that. So I like tokenization. I think it's going to take hold very much. But for us, it wasn't necessarily that much of a leap. Maybe for our banking customers, it feels like a big jump. But in reality, that's not where we're going to see the big value of blockchain in the next couple of years. I think Oliver Bussmann touched on it yesterday very well in the morning. That the interesting bit is the smart contracts and the fact that we can actually create shared business logic that spans outside of traditional siloed enterprises. So where we started was, okay, if we look at those smart contracts, how can we break up the world today and the use cases today to work out which space is likely to move first? So we created a model called the 3 Vs, volume, value, and venue. And if everyone in strategy like me loves their 2x2 matrices. So if you think about a 2x2 with volume and value, let's keep it simple with those ones first. Right, your top right quadrant is high volume, high value transactions. So that's foreign exchange, public equities, things like that. If you think about smart contracts in that environment, those markets are incredibly efficient. So we might well see that get impacted, but it's probably not going to be for quite some years. The foreign exchange market works incredibly efficiently. People may argue, yeah, you know what, it's 3 days settlement, but to be honest, it's an industry standard and there's a lot of people behind that. It's not necessarily a huge deal to deal with that. Sure, if you replace that with tokenization, great, you get some efficiencies, but in the bottom left quadrant, you've got low volume, low value. So that's rewards programs, music royalties, peer-to-peer lending, right? That space is moving now already. And I think we've seen peer-to-peer lending take off in some forms. The role for banks there is that they are very experienced at lending. All of these P2P lending platforms and the robo-advisory kind of capabilities have never seen a market downturn. We have no idea how good their algorithms are. So the smart contracts play in that space is going to be really interesting. And I think, I went round next door. There are quite a few kind of rewards and loyalty space operations there, and that space is ripe for a use case right now. And I think, I know of a few banks who are thinking about that actively. The bottom right quadrant is high volume, low value. And that's your Internet of Things and your distributed computing. So IOTA was mentioned yesterday in the IoT space. There are plenty of others. I'd recommend looking at something like Golem, which will disrupt because you don't need AWS, Bluemix, Azure, and Google now as your centralized compute providers. You can use decentralized, and you can borrow a supercomputer for 15 minutes if you need it, and just pay for that piece. We're nowhere near getting there yet at scale, in particular for banks. I think they're still working out, heck, I've got to get to a centralized cloud provider in the near term to enable operational efficiencies, let alone a decentralized one. So that's much further out, which leaves the last quadrant, which is high value, low volume. And that's perfect for blockchain, right? If you don't need settlement like instantaneously, so you've got venture capital, private equity, syndicated loans, OTC derivatives, all in that space. And we built Block 1 IQ so our data feed adapter for blockchain specifically for OTC derivatives. So people can call equity data, FX data, LIBOR, and other benchmark rates to enable them to experiment in that space around interest rate swaps. Right? So you can represent an interest rate swap pretty easily as a smart contract. It's 75 lines of code, more or less, and looks very much like a crowdfunding campaign contract in a way, which is roughly the same length of code. And so we've seen several of our customers come to us asking for LIBOR rates for those sorts of use cases. So I think high value, low volume transactions, VC, PE, OTC derivatives, syndicated loans, are going to be the use cases where we see traction in the nearer term that's beyond the tokenization play.
Thank you very much. Fantastic. This metric, I think, is very, very useful. But we have heard about different use cases and applications, but that involve a different level of innovations. Cryptocurrencies, of course, is the simple case, but if we move to new applications like application in the derivative market to streamline the settlement, or in the trade finance, the level of innovation is larger, and even the level of complexity is larger. So in this matrix of innovation and level of complexity, which require the coordination effort between different stakeholders, not only within the company, but also outside the company, where we should position, Giulio, what do you think about, what are the use cases that are basically more easy to implement and a more long-term type of applications that we can see in the future?
So I think in the short term, there are use cases around what I would call, for example, workflows, which involve a lot of, well, at least different parties, and and they don't really involve the need to transact value, right? Examples of this could be global anti-money laundering, regulatory reporting, this type of things, right? Because I think blockchain technology enables or gives us a way to actually share information across different parties without having to create secure communication channels and having a single version of truth as of what is going on, right? And I think that's a first source of efficiency. It's the most boring and the least transformative and so on, but it is something that we need. I mean, take, for example, global anti-money laundering. As you know, Santander is a collection of different banks in different jurisdictions. And suppose that a bad guy comes to one country, and then we kick him off, and then the same guy goes to another country, right? When this guy goes to the other country, we cannot take a look at the databases we have in the first country, right? Because of data protection jurisdictions, I mean, all these data protection laws and so on. So if we find a way to actually share this information without explicitly sharing the data, then we can create distributed global networks without having to put all the information in the same place, and we can do things like, for example, fighting global crime. Or think about regulatory reporting, or, I mean, there are many places where we can actually benefit from having a single version of truth where different parties have to exchange information. Now, when it comes to payments, this is mostly what people are doing these days. When we're talking about payments, we're talking about exchange of information only. We're not talking about doing really settlement, we're talking about just the messaging layer. In order to be able to make, to take the next step, what we need is to be able to actually store value on a decentralized platform, right? And we need to get ready for that. That's when tokenization takes place. So because when we do that, and we do have production, systems in limited production these days, then you can actually accomplish the whole thing. And in the case of payments, really the key is not so much the information sharing, it's actually liquidity management. You see, when you do international payments, you essentially need to pre-fund Nostra accounts, and that is amazingly expensive. So when you can actually represent value on top of a centralized ledger, and that value can be seen by the whole platform, the whole industry, then you can optimize the amount of liquidity that you use when you do international payments. That's actually a very important point. But in order to do that, you need a way to store value on a decentralized platform, which is a big leap. It is possible, and probably the end of the journey is when that store of value platform is actually native. Imagine a common platform, something similar to Ethereum, just to play with example, where all the banks have different wallets which represents their bank accounts. So that would be a common core banking system where all the banks would have logically separated their accounts, but everything would live in the same place. You see, that would unlock all the potential value of blockchain technology in this sense, because all the value would be living in the same place, and we would accomplish really what we mean when we say the Internet of value, right? Today, the Internet does not support value, right? It's the Internet of communications, but all values are stored in individual parties. With a system like that, then value would live on a decentralized way as well, would be reflected. It would not be controlled by the community, it would be controlled by each individual party, but it would live on a common platform. And that would be kind of the end of the journey, I would say. I think we have seen good applications of the first phase. I think the second phase we're getting there, and I am seeing, or at least we are doing international payments, not just the messaging layer, but the whole thing, including liquidity management, which is really the key. And I think it's years to come until we can really go to the third phase.
Thank you.
Can I just add a few points? Yesterday on one of the panelists raised something very interesting. From a regulator's perspective, I think blockchain can also be used in order to pass legislations to stakeholders in the industry. Another interesting use case, MAS in Singapore, they have been working on a project to have a national KYC utility using the blockchain. And that will be opened to all the stakeholders in the industry. That's another interesting use case from a regulator's perspective that I believe blockchain can be of great use.
Thank you, Yasmin. Just a very quick question and very quick answer before to leave to the floor. So we have been talking about tokenization. We know there are a lot of, I called a few years ago brand currencies in one of my writing, and these are type of new instruments for us. We don't really know how to handle with them. There are a mix of equities, a mix of currencies, a mix of utility tokens. We don't know how to price. So these are very risky assets. And we are going to end up with thousands of them in the years to come. And what will be the situation? How banks will react to this? What is your opinion about that?
But very quickly, I mean, we live in a world of multi-currencies, right? We've got tons of, every country has their currency today. So I think we're very much used to dealing with various currencies. I think the difference will be, will we have central bank digital currency that will have a higher volatility and maybe new features that will make a change and that will require some adaptation on existing operations and processes. But I think that is just one part of the enabler. Tokenization was mentioned, and digital identities, as we said, and that together will give us the ability to actually create new markets, and it's very interesting to see how with new digitized assets on the blockchain, I mean, we know about the diamonds, the real estate, but also the combination with smart cities, how that will actually shape the ecosystems where transfers take place, and then initially at some point we'll have the passover, the transaction of true value as well as we get those regulated currencies on the networks.
For me, I would say just two things. So one of them is when we talk about tokenization, tokens. So tokenization of assets, that's not going to be really complicated to deal with because they are just a digital representation of an existing asset already. So there is not much work need to be done by banks or regulators to understand how to deal with these things. The other part is when we talk about cryptocurrencies now. So cryptocurrencies, some of them actually, they're probably considered like a new asset class actually in themselves. So they are not anything that we already have or know. So they're not gold, they're not pure currency, they're not pure commodity, they're not an equity, they're something just new. So we need to understand that, and this is where we need everyone to come together to kind of formulate this new asset class, to deal with it better. So.
Yeah, I guess I would echo that. So when we look at crypto assets in general, there's the group which don't have anything behind them: Bitcoin, Zcash, Dash, Litecoin, Monero. They're the groups that do have things behind them, which is tokenized assets, right? Oil and gas, the Venezuelan oil coin, or lots of other examples like that, right? We've got lots of customers who are looking at liquefied natural gas tokenized on an exchange, right? Or already customers talking to us about that. So there's the asset-backed group, and then there's the third group where it isn't actually an asset or non-asset. The token represents a right. So it's a right to vote, it's a right to enter a building, it's a right to whatever it is, right? So you could call all of these more broadly tokens or currencies as a very generic term, but we'll see hundreds of millions of these, right? And you're probably going to have a scenario in the future where you've got a wallet that's got loads of them that are useful in different scenarios. Catalonia now, because of the social uprising at the moment, they have the Croat, or Croat, I don't know how they pronounce it, coin, right? And it's a social coin. It's driven by a social community need that goes beyond the ability for the government to use it. So there's a social impact, very much a social impact here, which sometimes people miss, and I think it's not really something that's on the radar of the banks that we speak to at the moment, but there's going to be an ethical question at some point in, do Catalonian banks accept that as a currency for deposit because they want to support Catalonia, or do they say, no, this isn't a government currency, we can't hold this? That's going to be a really interesting point in time.
So don't get me started on Catalonia, please. But what I would, what I wanted to say is cryptocurrencies are, as we know it today, a form of cash. And you know what? Cash is bad because cash is anonymous, and cash cannot be attributed to people, right? So cash is probably the best instrument you have to do money laundering, right? So I think why Bitcoin is good, right? So there are several aspects to that. The first is that it is global, and yes, we can use a global asset to exchange value, definitely, right? But Bitcoin is anonymous, and that is bad. So for me, cryptocurrencies are difficult to use because they enable uncontrolled use cases that we have been years, decades, centuries trying to fight, right? So if we could find a way to build a cryptocurrency, maybe on top of a permission ledger with enforceable identity registration. I know this goes against the crypto-anarchist movement, I understand. Right? But maybe something like that can actually achieve the globality kind of benefits, right, which we all want, without creating the money laundering risks. right? And about your question about the utility tokens, I like this idea of having utility tokens as a way to control the activity in the network, right? And also as a way to do like invoicing, for example. In the case of Alastria, this network that we have put together in Spain, I always talk about, we are actually reenacting the concept of Ether. With a cost of gas bigger than zero on top of a quorum network, right? Which sounds like a very strange thing, but the idea is not to sell that Ether and speculate with it. The idea is actually to use it as a way to control the level of activity in the network, because otherwise I cannot stop you if you want to spam the network, you see. So using utility tokens to limit or to control the level of activity in the network and do invoicing as well, right? It's a very good way of doing invoicing for network access. I think it's a good idea. Now, having utility tokens to speculate with them, it defeats the purpose and it makes things expensive and really not useful. I mean, Ethereum today, as it is impossible to use for anything because it's so expensive to make a transaction. It's like $3 to make a transaction. It's just useless for many things, and it's swamped with CryptoKitties and ICOs. Right? So I think what we need is enterprise-grade permission networks which are scalable, on top of which we can experiment with the same concepts that cryptocurrencies and utility tokens provide, but on an identified way and a more useful way.
I fully agree with Julia. I think there's these two misconceptions on the whole topic. One is smart contracts aren't contracts, they're business logic applications, and cryptocurrencies aren't currencies, they're digital assets, digital tokens, and some might be used or perceived by some participants in the market as currencies, but effectively they're not. That's, I think, where we're looking for some digital cash or some other ways to go about it. And when you differentiate that, I think then you can have an intelligent discussions about how to move forward.
So thank you very much. Join me to thank the panelists for these enlightening answers and thoughts. We ran out of time. I would like to pick up one, maximum two questions from the audience. A quick one, over there.
Yeah, it's a question for Mr. Chadwick. When you mentioned the cryptocurrencies in Catalonia, and if the banks that would be accepting that cryptocurrency, I think the big issue is that the banks in Catalonia, they are fleeing out. They are moving to other regions in Spain, so there is no way to sustain that. And actually, it should be not just as a technical or technological issue based in the blockchain. It's a geopolitical issue. Because Russia is being proved that has been interfering in the process in Catalonia. So the cryptocurrency, I don't think is going to support that.
I completely agree, and I think that was the point I was trying to make, was the social impact of these currencies, that it goes far beyond just the technology use cases, and would technically it provide some new capabilities, but there's the social and geopolitical elements to consider as well, and that there are lots of questions which aren't simply just, is this regulated or not regulated, does this work, are the transaction fees too high, et cetera, from implementation. There are other elements that are going to result in lots of different currencies, or tokens, rather, being created, that's going to mean that we live in a multi-token world. And that's going to generate more questions. That was my point. Maybe, sitting aside, Julio, it was a bad example to pick Catalonia. Maybe, the Hungarian e-cryptocurrency that they're creating at the moment, maybe I should have gone with that one and hoped there were no Hungarians in the audience But no, I think you're spot on. It's a geopolitical question, but I just wanted to make the point that it raises very different questions that maybe panels like us can answer at this point in time, and we'll arrive at those in the future.
So thank you very much. I would like to the last question, because we really need to leave the floor for the other panel.
Thank you guys for the inputs and the feedback. I think. Just to give you a small introduction, I'm sure you're aware in the region, with the oil prices going down, deposits have reduced from the government. There's a lot of consolidation in terms of banking in the market. Yet we're seeing a new ecosystem, a new capital markets being generated, which is the cryptocurrency world, which is now, I don't know, it's about 450 billion and growing massively. Now, as innovators in the banking sector, what are you doing to capitalize on this new capital markets ecosystem? I mean, obviously you're adopting to some of the technology startups, and you're working with them to solve your own problems. But those technology startups need funding, and they need support. So what are banks doing to support those startups, apart from just using the services? Why they're not participating in this cryptocurrency ecosystem, which I know there's preservations from the central bank, and I think central banks in general are looking into it. Some are more open than others. It's understandable, but why are banks not lobbying on behalf of those startups?
So why you're not collaborating with the startups?
So actually, the thing about that is because there is the whole model now, what they call the ICO model, which is the initial coin offering, or maybe that term is a little bit toxic nowadays. But the idea is, it's why is it there and what does it do? So it solves a problem of funding. So whether it is regulated, whether it is good or bad, whether it needs more attention into how to shape it, that's not the point right now, because it will probably need a lot of work. But as a tool for startups, as you said, and as a tool for innovators to fund themselves up and to build these innovations, I think it's an innovation by itself, and that allows actually people to do these kind of innovations. Banks in general, I think there are a lot of banks who have their venture arm or something like that. They do invest, and usually they will probably acquire you rather than invest in you. And that's at least the case we faced. Invest guys, they will say, okay, we'll buy you over, and it's like, no, thank you. So we leave and we go to private investors rather than banks. But the ICO model is there, and I hope that there is more regulation into that allow people to benefit from it rather than ban it altogether, as we see in some countries.
Thank you. Julio wants to say something quickly?
Just very quickly, I think this is actually very fundamental. Startups or banks, big corporations it's always difficult for big corporations to work with the startups because they're very different, right? Suppose we get a great startup and want to work with them. What are we going to do? Are we going to deploy their systems within our firewall, close to our core banking system? I mean, that is difficult. Now, blockchain gives us a great opportunity, right? Because if we the banks, tokenize our assets and put these digital representations of things on top of the blockchain, now the startup can come and build new applications, actually not with just one, but actually other actors in the capital market. So if they work on the tokenized world, right, that avoids the need to integrate their systems with our systems. So I can see a world where the large corporations tokenize their assets, bring these assets to the blockchain, and then the startups innovate on top of the blockchain, because it's a much more efficient and a much safer way to innovate as opposed to the traditional way, which is trying to deal with big corporations with big cybersecurity constraints and big procurement processes and all that. I think it's a fundamental innovation paradigm that we will see in the next years to come.
Thank you very much. Thank you again.